Good morning, everybody. Thank you for all that showed up. There is breakfast and coffee in the kitchen area. But I'm not going to hold up your time. I'm going to introduce to you Jeremy and Doug with Castle Rock, and they're going to take it away.
Good morning, guys. First, who are you? Who's that? That's Trouble. I know her. Awesome. I'm Jeremy with Castle Rock. This is Doug Smith. I've been in the industry about 5 years. A lot of people ask me, like, how to get in the industry. Real quick background. I died at work in 2020, saw heaven. So I tell people God killed me to get me in this industry. This industry comes with a lot of stress. So I think God's trying to kill me again. This is my broker, Doug. I'm gonna let Doug introduce himself briefly before I get started.
My name is Doug Smith. I guess I can be seen here. Oh, yeah, hey there, Ann. Doug Smith, and I actually been in banking for 35 years. I say banking because I started in mortgage, was moved to Florida in 1996 with Bank One in the mortgage division. Went into banking with First Union Wachovia for about a decade and a couple of community banks, Pilot Bank here, handling commercial lending and whatnot. And then back during the last crash, that's when our company started, mainly as a commercial bridge lender to bail banks out of jams. And then we went back to what our roots were. We decided that we would kind of try to do things a little differently. Wanted to build a company that was really for the professionals, not only the loan officers, but also the agents and the title folks that were trying to support them. So we try to run lean, mean, as you're going to see here in a few minutes. We don't have a lot of overhead on purpose. We don't build in the profit legally. Companies can build in a certain amount of profit, and almost all of them do. We actually have got that cut. The profit margin that we have is less than half of what anyone else that we know is running. So that being said, that's why you're going to see some of the numbers that Jeremy's probably going to share. I haven't seen his presentation yet.
Oh, he's in for a surprise too. So I'm a big basketball fan. So I mimic my business after Kobe Bryant. His mentality is called the Mamba mentality. He always want to be great. So I tell realtors when they're coming in, if you're new, be different, be original, work hard, outwork your competition. That's kind of where the Mamba mentality came from. If you don't know it, definitely Google it. There's books about it. It'll definitely help you grow as a realtor. It helped me grow my business. I'm a little too fierce. I think Doug can agree. But I always want to be on top. I always want to win. I never settle for second best. So I tell every realtor that's sitting here on Zoom, always be the best. That's why Kobe is a Hall of Famer, because of the Mamba mentality. So I work for Castle Rock, but I have my own team, the Lone Rangers. We do not wear leotards. We don't wear masks. We're not doing that. So I am the face of my team. Matthew Pagan, he does my back end. He clears all the conditions. Crystal Pentai, the girl in the middle, she is the most important person on my team. If I do a deal with you or anybody, she's the one that clears all the documents up front. Jimmy Stringer, he manages my team, and Brittany DeBalo, she's one of my assistants. But this is my team. We're the Lone Rangers. We don't ride horses. We just fight for what's right and clear condition to get people in homes as fast as possible. On average, we're usually about 0.75% to 1% lower than the national average for interest rates. That's super important, not just for the client. Clients love lower interest rates, but it also helps you guys as realtors. Lower rates, clients get more buying power. More buying power means more commission for you guys. So that's super important. So I definitely tell you guys to have your clients rate shop as much as possible, get the lowest rate as possible, because it gives them more buying power. And I'm gonna go into a little detail about it. So side by side, on the left-hand side, that's a lender with a 6.99% rate. On the right side is 5.99. The difference is $236 a month. That's a lot. That's a lot of money to save someone. But the big thing is what I'm going to show you here is, say they're at 6.99 and you're showing them a home. Say, Lisa, you're showing someone a home, and they're like, oh, I really want that $470,000 home. Well, that lender at 6.99 can only qualify them for $450,000. Then you call, say, Castle Rock or someone with a lower rate, 1%. They'll have a buying power up to $483,000. That's $33,000 more in buying power for the client. Now, say you're hypothetically making 3% in commission, which is awesome. Hopefully you all make that. That's $990 extra in commission. If you do 24 deals a year to a month, that's $23,760 in commission in your pocket. That's a pretty nice little Christmas bonus. That's why rates, it doesn't just matter to the client, it matters to the realtor as well. And again, we're in this to get people in homes, we're fiduciaries, but again, if you can get them a happier rate and you can also make more commission, that's the end of the goal. So I definitely want to touch on that. The big thing that's going around the industry right now is a lot of people ask me, what should we do? Should we offer $10,000 less? Should we get seller concessions? I'm going to tell you all day long, you should get seller concessions for 2-1 buy downs, temp buy downs, and help with closing costs. But I want to show you first. So hypothetically, the same scenario, if you offer $10,000 less with an interest rate of 5.99, it saves them only $59.89 a month. And some people might be happy with that. Me, I go the extra miles. Like, I want to help you currently and in the future. So this is what I wanted to show you. At the top, well, I can't see it. How do you get this off the screen? Let's get this okay. It's 2-1 buy down. So what it cost them is $7,981. Keep in mind you had $10,000 because you elected not to buy the purchase price down. Year one, it's going to save them $439.45. Year two, $225. And what this $7,981 does right here, it goes into an escrow. Each month, this savings deducts from this. So say in 6 months, the rates tumble, and it's a possibility. And, a client calls me and says, hey, I want to refi. Like, the rates are great. They're, I just want to have a permanent rate in the 4s. Cool. Whatever money's left over out of the $79.81 for your savings goes back to them in a check. So it's still their money. Whereas if you if you do a permanent buy down and you waste your money, you'll never recoup it. So that's one of the things. I know Lisa, she's experienced it as well, and it's a big deal. We've closed people now that's in the 3s, the 2s with a 3-2-1 buy down. It's good. A lot of people ask me my opinion of it. It's technically a Band-Aid. However, they're going to recoup their money better than better than a permanent buy down. Or, again, you're saving $439 compared to $59 a month. So it's a no-brainer to me. I'm a numbers guy. I try to save people money. And that's my go-to in the current situations with the interest rates. All right, so here's your 2-1 buy down, kind of a breakdown. This kind of shows you. So year one, the same scenario, they'll be at $23.33 for a monthly payment. Year two, $25.47, and then year 3 through 30, they would be at $27.72. And that's kind of on the side there. It talks about the $79.81 where it goes. Essentially, it goes into an escrow. Each month, the savings comes out like we were talking about. Super important. It has to come from seller concessions. It cannot come from a realtor credit. If you guys need any help with that, my baseline is usually figure about 2% for a 2-1 buy down, about 3.125 for a 3-2-1 buy down. That's kind of your rules of thumbs. But anybody in the room or online, if they have any questions, definitely contact me. I can always help with that, but it's super important. This is the Bible of lending. I want to kind of share this with you guys real quick. I know it's on the lending side, but this kind of shows you a person's credit score, how it affects their DTI.
You're going to provide this to them, right?
Yeah, absolutely. Yeah, absolutely. So this is what I teach my team. This is how I can get a pre-qual done in 2 minutes. The first question I always ask them, what's your credit score range roughly? As you see, the lower the credit score, the DTI, their buying power goes down. It's super important to follow this. I'm going to share it. Megan will share it out. If you ever have a client, and I'll get a little scenario. I'll show you how to figure out like a monthly payment, but I do it all the time. Lisa can tell you, I always do it for her. But this is my go-to. If you can get this figured out when you meet a client, this will kind of help you figure out their buying power a little better than just kind of going into it blindly. This is kind of like a little scenario. Again, Megan's going to share this out, like DTI calculations. This kind of breaks down like, a scenario if they came into your open house, Jeffrey makes 100,000, Tanya makes 24 an hour. You kind of figure out what they make per month. Then you figure out their debts. So the next scenario, so it shows you, Jeffrey makes roughly 83.33 a month. Tanya makes roughly, let's see, 41.60 a month, which equals 12,493. That's their gross income, minus their debts. Now here's your big breakdown. And this is why I wanted to show you this on the screen, because a lot of people ask me, should I go conventional? Should I go FHA? FHA, the con to it has upfront mortgage insurance of 1.75%. That's a con. The pro is you don't have to put 10, 20% down to get 6% seller concessions. At FHA, you also get more buying power. As you see in this scenario, for a conventional, they would only qualify up to 51.41 monthly payment. Whereas with an FHA, they qualify up to 6,000. There's a big misconception with FHAs. They think they're just for first-time home buyers. It's actually not. I have clients now that have 800 credit that are going FHA because they want the seller concessions to do 2-1 buy downs and stuff like that. Not everybody has 10, 20% to put down, but they want to take advantage of a buy down. My rule of thumb is if you can get 6% in concessions, you can get a 2-1 buy down covered and your closing costs covered for your client. That's super, super important. It's probably a little throttle, a little high. Any leftover money we can use up to get a permanent buy the rate down a little bit, but that should be your rule of thumb. If you look at concessions, for a 2-1 buy down cover your closing costs, look at like 6%. But you can see like a lot of clients, they come to us like, man, I really want that house, but I'm over the DTI for a conventional. I was like, let's just go FHA and let's make this happen. And it kind of breaks it down, and Megan will share this all with you, all my slides, how you do the math and stuff. And that goes back to that Bible book. So if they have good credit, it'll be 0.5699, you times it by. If they had bad credit, you want to be at 0.47 for an FHA. So that kind of triggers down how you figure it out. I'm a numbers person. Anybody here on the room or on the cameras want me to break it down even further, but it helps realtors grow if they meet a client and kind of know like, okay, what's the mindset? What's their monthly payment? It saves you guys from driving around Saturdays and Sundays for homes they can't afford, essentially. But my team, we're always available. Crystal, Matt, Jimmy, the whole 9 yards. We price everything out. That way you guys are not wasting your gas and your time that you'd be spending with your families. But I want to kind of show you the difference because there's been a lot of misconceptions about conventional versus FHA. And just because they have a high credit score, don't mean necessarily should go conventional. It should always be scenario based. This is your max loan limits. Super, super important as well, to follow these. This is after you do your upfront mortgage insurance, like FHA. A lot of people don't realize you can get a quadplex over $1 million loan amount with just 3.5% down. If you can find one now, that'd be awesome. TikTok's kind of messed up your multifamilies. All the kids are doing it, but I've been following this for years. It helps a lot of people. Like if you find a duplex, I always tell them go FHA over conventional all day long if you can, because you're only putting 3.5% down and you have a higher loan limit. Anytime you go over jumbo loan, anytime you go over these loan limits for jumbos, there is a slight price increase, loan level price adjustment for the rate. It's not too bad. Definitely call me and I'll give you the rates either way. It's not too bad, but it is a little higher. But usually my jumbo loans are usually lower than most people's primary loans rates, so which is good. A lot of people, like, I guess there's some people at Century 21 that heard I was doing a speech and like, you've got to talk about new construction because that's what made you famous. I'm like, oh dear God. Sorry, Doug. I love new construction. I do. I love it. They have, it's new homes, lower homeowners insurance. However, as realtors, there's stuff you definitely need to watch for. That flex cash and stuff they're offering, a lot of times is aided with like points. As you see, this is like a real life loan estimate that I got. As you see, they were only getting, I forgot what it was. I think they were getting like $20,000 or something. They were using up 15,000 in points. They were using up in a builder's credit. So a lot of times you're not really getting your closing costs paid. And Megan can vouch too, when new construction is you're paying all the sellers closing costs. So technically all they're doing is they're giving this money and turn around and you're just using it to pay the builder's closing costs.
Can I interject something on that?
Yes.
Do you mind? So make sure that my mic's on here. So this is very important to realize with builders. And when you're You're going in and I see it all the time where an agent that we work with has driven and looked at 50 homes and no, we're not ready. And then all of a sudden they go under contract because they walk in on a Sunday to an open house or a model home and oh, you don't need your agent. We'll take care of you. Well, keep in mind that that contract that they're writing is not the FAR bar. And I wish I could recall, I should have looked it up on the way over here because I could have guessed you were going to talk about this. But, you know, where the boxes where you check who picks the title company on there, well, they're always pushing that onto the buyer, which normally it's a seller chosen thing and they have to pay for it. Well, that pushes that cost over. So those $18,000 or $20,000 that they're getting go to really three places. Points, because what they do, people don't understand. I can go get money for the same price that the builders can, at the same price that the big companies can, you know, your Rockets or whoever. Our cost of money is the same. It's what the profit margin that we build in is. The builders, oh, we're going to give you all these incentives to come to us. But what they do is they start the rate way up here, which means when they turn around and sell it, they're getting all of that money back and then some. So it's really not a good deal for the customer all the time, most of the time, to go to the builder. It would have to be an obscene amount of buy down. Have you guys seen the builders where they come in and say, hey, we're offering 4.99% rates? How do they do that? Well, they use that money to go out and buy what's called a derivative to actually offset it. So in other words, there's a lot of financial tricks they're using. It's usually not good for the customer. So I'm sorry to interrupt.
Oh, you're fine. So yes.
Absolutely.
You beat me to it, Angie. So actually, yes, no, you're good. You're good. So that was my next point is, you should always, whether I'm your preferred lender or whoever your preferred lender is, you should always send that over to them like, hey, Jeremy, look at this. Like, what do you think about this? I'm a little different. I love getting on the calls with the builder's lender, and I'm always called Uncle Ty or Uncle Jeffrey or whatever you want to call me. I get on the call and I quiz them on it. And what I do is your lender, what a lot of people don't realize is you can get a pre-approval from your lender and you can give it to the builder and watch how fast they change that rate. It's pretty quick. I just had one the other day. They were quoting on a VA 6.99 while I was at 5.25. And all of a sudden, out of the air, they're like, oh, yeah, we can match that. Because what they do is they buy stuff in blocks. And it's kind of like, I hate to say it like this, but it's kind of like communism. Everybody gets the same rate no matter your credit score. Because what they do is, and I'm a preferred lender. They've come to me. It's like, hey, what's it going to cost for a 580 credit score to get 5.25 or 4.99 like they advertise? And I'm like, well, it's going to cost $50,000. Like, okay, we're going to bump the purchase price up. We're going to buy it in blocks. Then you have someone say Angie comes in and buys a house and her credit's amazing. They're like, oh yeah, we're going to give you this higher rate. And that's how they make money, because they have lender credits for that higher rate. But when push comes to shove, that's why you always want to get an outside lender involved, because you definitely can get them a better rate. That's very big to remember. I look at them all day long, my team. This is actual one I chopped up for them. These people, as you saw, they started with 6.375. By the time I was done, they closed at 5% flat. Their cash to close went down like $18,000 because of the blocks. You know, I don't get on the call and say I'm Jeremy King from Castle Rock. I get on as Uncle Ty or whoever, but I can pick it apart really fast. So again, I don't always want to get the loan because a lot of times you have to use their lender, but it's important whether it's me or whoever you guys use as your preferred lender to get them involved to help out, because at the end of the day, our job is to get a family into a home with the best deal possible. And usually out of the gate, unless it's the end of the year, you're not going to get the best deal possible unless you kind of dig a little deep. The one thing I will tell you, everybody in this room, is the reg tag special. Everybody loves them at the end of the year. It looks great. They get savings. It's also bad for buyers that bought it the first year, and then when the neighborhood starts, and say they bought a home for $550,000, and then the red tag special comes in at $475, and say that same family wants to refi or God forbid sell or anything. Or, you know, I just had it happen last week. We had to deny a client because they paid $600,000 for a home. We did the appraisal. It came in at 475 because their comps was those red tag specials. She lost $125,000 equity within 11 months and she had to refi because she was going through a divorce. Now she is SOL because there's nothing she can do. She's upside down. She can't sell it because she's upside. I mean, it's a mess. So definitely get me involved as well, or your lender as well, because if the neighborhood's starting, sometimes it might be better to get the purchase price down a little bit to protect them from losing equity in the back end. So that's what the reg tech special warning. If you follow me on social media, I post about it a lot. And another big thing is I'm friends with a lot of inspectors out in the Apollo Beach area. If you don't know Corey Weaver, he's absolutely incredible. So is Dale Gertzberger. They're both incredible. And I talked to Corey yesterday and I was like, what should I put in this new construction? And he laughed. He's like, man, just tell the realtors, please do a pre-drywall inspection, a final inspection. If a builder tries to steer you away from that, be leery. You want to catch everything behind that drywall before the drywall's up, and you want to catch it at final. Again, if you need Corey's number, he's incredible. So is Dale. But that was their words of advice. I was trying to get Corey here today, he couldn't make it, but that's my words of advice for everybody here. Definitely do a pre-drywall. And again, I'm not picking on new construction. You know, they build good homes, they get lower, you know, homeowners insurance. Definitely be leery on the lending side, because they can do crazy stuff like this. And if you don't have someone to catch it, you know, and I think Angie kind of, you know, said a little bit too, make sure your clients, if they're going to go around, look at new construction, you're not with them, make sure they tell them that you are the realtor, because you will get boxed out, and they love doing that. I've heard so many horror stories. I just had one the other night. This lady, you know, one of my realtors showed this lady like 60 homes in 2 weeks, and she went new construction and she just got boxed out because she didn't tell them she had a realtor. So definitely be super careful about that. Again, love new construction. When it comes to this, I do not like them. This is actually one of my clients. You know, a lot of people ask me like, how come you're not part of like clubs and go to these events and give yourself trophies and all that stuff? I do post, I do get a few awards, but that's my trophy. Everybody in this room, everybody online, that should be your trophy. That should be, that's actually a realtor giving the keys to a lady, a single mom with 3 kids. That's our trophy, getting keys in the hands of our clients. Yes. Yes.
I'm sorry to interrupt you. I wanted to give you kudos back on, I don't know if it's the same closing, but we had a closing. It was a VA assumption and the lender really screwed up the buyer or the seller. All her entitlements went away, to this new buyer, and she was trying to buy a house. She's a single mom of 3 kids, and she was really screwed. Jeremy came in, got on the phone with the VA, had me on the 3-way, got this lady her house. So just huge kudos, because I've never seen a lender go above and beyond like that. And this lady's whole world turned upside down. So just wanted to jump in. I thought of it and wanted to give you the kudos on production.
And I actually got to speak with that woman long after that. I ran into her at an event. She had to come up and tell me all about it. And I'd heard about it when it was going on, but yeah.
I was actually on my way to get engaged that Wednesday and went to the VA in St. Pete, and so they kicked me out to get her entitlement back. And I'm glad you actually brought that up, Megan, because it's not part of my slides, but I want to like touch on that very important. Assumable mortgages, they sound great. Oh yeah, you know, if you have a VA that's a veteran that's going to do it, make sure the buyer has the entitlement. Please make sure. If you need help, let me know, because what will happen is they can assume it. And if they don't have the entitlement, your veteran lost their entitlement. The other thing, what people don't realize is with assumable VAs, if that buyer that assumed it goes in foreclosure, your veteran is banned for life from getting a VA loan. Again, it's super important. I know there's the realtor here that she's going through another one currently. She was actually the realtor on the one that Megan was just talking about. I'm the first one in 15 years to get someone's entitlement back. It was a fight, but it's hard. You got to watch it very cautiously, because you can't use your lender, your preferred lender, to do the loan. You have to use the bank that you're assuming from. And I hate to say it, but not everybody's good at VA loans. And if you don't check that entitlement proper from the buyer, they are screwed essentially, and there's nothing you can do about it. You can fight it. I won. And Doug can tell you, I taught him about it, and my Freedom Mortgage, everybody thought there's no way, absolutely no way. And I escalated all the way up for that lady, who's one of my good friends as well, but definitely be careful about assumable mortgages. They sound good. Are you coming back again? Oh, I don't know. I'm supposed to be doing that. Let's see. Yeah, I'll let you read them out to me. You want to call them out to me and I'll just answer them? Sorry, guys. I didn't know I had questions on the chat.
So, should typically take in payments to make a payment worth the buy down. Example, 5K buy down is saving 100 a month.
Well, for a buy down, like a temporary buy down, I'm assuming is what they're talking about. So if you did 5,000, that's going to essentially,
Go ahead.
depends on the purchase price. That could get you a 1.0 or it can get you a 2.1. It's going to save you a little more than $100 a month. Whereas if you did 5,000 permanently buying down, or say, let's just start 5,000, lower the purchase price, that's going to save you $20 a month, roughly about $21. If you did 5,000 and bought the rate down, it's only going to buy your rate down 1/8 of a point, which might save you $14. Permanent buy down is always going to be, even a 1.0 buy down, you're still going to save $170 to $200 a month for year one. That's what I would do. It depends on the purchase price. Like if it's a lower purchase price, like 280, you can do a 2.1. That's going to save about $386 year one, roughly. So
Next one is most seller concessions given are up to 3% unless it's VA, then 4%. What are you getting? Where are you getting 6%? Does this include compensation?
so 6%, there's two ways you do it. Angie's been involved in some of my negotiations. So is Lisa. You can't always get everything. So you can't go into a home that's $500,000 and ask for seller concessions, and say, I want to offer 400,000. A lot of times you might have to offer over the asking price to get it. And a lot of my clients, they go back and like, why would I do that? I'm like, well, let's see, if we go to 510, you get 6%, you're saving $400 a month year one, 280 year two. And your net, your payment goes up $40 a month roughly, but you're getting 6% you get on your closing cost. 3% is only if you put less than 10% down on conventional. That's where a lot of people steer to FHA because you can get max 6% with 3.5% down. For a VA, everybody thinks the rule of thumb is 4%. It's not. 4% is the max you can get for closing costs. You can get up to 500% if you really wanted to. Everything over 4% has got to go to the rate for a temp buy down or points. So that's how you get creative with it. But you can get it. Now, the lower the interest rates go, the more buyers come out, the less likely you will get seller concessions. It's a cat and mouse game is what it is. You're negotiating. You should always, always, always try to get it for them. Doesn't necessarily mean, again, it goes back to the sellers as well. Not every home can give you 6% because they might be in the red. They might just be breaking even. But I'll tell you, Doug can see all my closings. 99% of my clients right now, I think I got 35 under contract. Every last one has seller concessions. I step in, I help the realtors like, hey, let's do this, let's do that. Go
Why
ahead.
don't I take part of that? You said compensation. Do you mind if I
Go ahead.
go off a little bit on
Yeah.
that? Because that's probably in everybody's head. I'll try to step out of the way here if I can still be seen. Legally, we're a mortgage broker. Okay. We chose not to be a mortgage lender. Mortgage lenders and banks can build in pretty much whatever they want into the pricing. They can make it in three ways. They can make it in bumping the rate up. So, whatever it costs us to get the money, which is pretty much the same across the board, we mark it up. And then when we turn around and sell that loan on the secondary market, there's a profit for us. Okay. We can also charge points like we showed before. Yep, that's it. The 10-year treasury is kind of so basically there's a little bit of a markup above that. Our rates are basically derived off of this, and it's a much more complicated thing, but we can make up to 2.75%, but we can only make it on the rate or charging points. A broker can't do both. We are maxed at 2.75%. That's all we can charge. Now, what we decided as a company to do, and when we were doing our introductions, we were talking about kind of maybe a difference in what makes us different, is that every quarter we allow our loan officers to get together and they together decide on what that markup's going to look like. Right now, our markup is 1.25% plus $500. Everybody else is pretty, well, I say everybody else, but most of the bigger companies are at 2.75. The banks, way above that. The other lenders are way above that. So when you say the compensation, now we have to he mentioned Freedom Mortgage. You hear UWM, you hear Rocket, you hear all these other big companies, right? And their wholesale channels, which we get it a little cheaper. Whether it's New Res or whoever it is, we by law have to charge exactly the same amount to everybody. Otherwise, we're discriminatory. It's actually against the law to charge more or less. Now, there are times there are situations where we can go below, but I have to be the one to sign off on it, and I have to write a whole brief to compliance on why we're doing it and why it's legal. Okay. So when you ask about compensation, that compensation is either built into the rate or built into the points. And Jeremy's actually kind of mastered it. It's almost like a football team. If you're a big football fan, they've got a salary cap. You got the cap guy. Jeremy's the cap guy. He's very good at figuring out exactly how to save the customer the most money to help your customer get into that house. So that's how compensation works. And I know that's kind of been in the back of everybody's mind. Okay, what do these guys make on it? We make 1.25% plus $500. That's what the company makes. And then the overhead comes out. We get a full-time chief compliance officer that we're required to have. Got to pay that salary and whatnot. So we try to keep that overhead low so that we can pass that savings on to the customer.
And the one thing I'll piggyback to, and if she was talking about, I'm not sure if it was a man or woman, if they're talking about like realtors compensation, again, if the buyer has to pay for it, then it does go into Alta, unfortunately. I just had one yesterday. I was on the phone with a realtor, like, hey, you got 6%, but they're paying you 2.5%. You can't bump it no more on an FHA. Like once the seller gives you 6%, you can't go over that. So they're boxed out. So I had to renegotiate it. It was with Open Door. I'm not going to hide. I'm not going to sugarcoat it. So I had to go back to them like, well, I know that's how you used to do it, but that's not how we do it anymore. Like, so you're already paying the realtor's compensation, which is fine. So we're going to put that to the side and you're going to give them 3.5%, but they want to bump their purchase price up another $4,000 to get that in concessions. And that's how you work it. The way I do it a lot of times too, to piggyback, I know we got time constraints, is a lot of times they go under contract, say hypothetically go under contract for 400,000, they get 2%. Angie's heard me do it. Lisa's heard me do it. Kalani's not here. She's heard me do it. I tell them, it's like, okay, they just showed their hand. It's like poker. Like, okay, like you're walking around, they say, here, I got 4 aces. Here we go. Once they accept your offer, you can go back to them and say, hey, I know we're at, 400,000 with 2%, but I want that other 2%, which is like $8,000. So let's offer you 408 now and get that extra 8 goes to seller concessions because you already saw their hand, their bottom line, essentially. I call it, I call it like, you call it whatever you like, but I just call it like, they're showing their hand, their cards. So that's another way you get around it. I tell all my clients from day one, like, be prepared to pay over if you want seller concessions. But a lot of sellers and a lot of listing agents I've talked to, they also know they're competing with new construction that are giving away 48, 50,000 in flex cash. So sometimes you're like, well, you want to move the home or not? I tell my listing agents, a lot of listing agents come to me is like, hey, what should I do to make? I say, well, you should probably talk to them about concessions up front because it is a buyer's market, that way they're mentally prepared for it. But there's sometimes we just can't make it work. We can't get the full 6. We can only get 4. We can get 3. That's where like, okay, well, we can use some of that for a buy down, and you can pay some of your closing costs essentially. I'll tell you, if a VA gets 4% concessions, they are going to get a check back at closing. They're going to get, if not all their EMD back, majority of it back. So you're helping a veteran get into a home pretty much for free. And I was DOD for 20 years. I'll tell you, every veteran deserves to buy a house for free, the stuff they go through. I want to make sure we didn't block the American flag as well, but just definitely like the seller concessions, super important. It comes with, you guys are skilled. If you're with a great brokerage, like Century 21's amazing. Chris and Craig and everybody, they'll tutor you up if you're struggling with that. You got some alphas out here like Kalani and Angie Richardson and Lisa and stuff that can help as well. But definitely fight for your client. I'll leave it at that. $5 a question.
This one, he's asked a couple, so John, but yeah. How do you take care of closing costs that the builder is picking up if you do the loan?
So a lot of times this is what happens. So I sent out my pre-approval and they call me like, how are you doing this? This is insane. I want an actual pre-approval. Like, here it is. Here's all the rate. Here's all the fees. They have two ways they do it. A lot of times they'll come to me like, hey, we can't match that. We're still gonna give them the credit. Or they're going to turn around and say, yep, our lender just playing, they can give them that rate and we're going to keep them the incentives. My clients get upset. They're like, oh, we love you, Jeremy. It's like, I love you too. Invite me to the housewarming party. I love barbecue. Um, the end of the game is to get their flex cash used and get them a lower interest rate. Um, the other way you can do around it, if it's like a conventional loan, I tell people like if they're not willing to work with you and you love the house, don't waste that money in points. Don't do it because a conventional loan you can refi anytime. Don't waste it. You're never going to recoup that money. So I coach some of my clients like, hey, be okay taking a 6.5% rate. You're not wasting $18,000 in points that you're never going to recoup. So there's like different sides of it. I've worked with all the builders. I am a preferred lender for David Weekley. But all the other ones, I got, Ryan Holmes right now. I got D.R. Horton, believe it or not, Lennar, because they couldn't match the rate. And at the end of the day, I get on the call and I tell them like, hey, what's more important? Close this home, getting a family in, saving face, or trying to gouge? And that's how I get with it. A lot of times the
and their
lender,
licensing, Jeremy, the way that they're like the in-house lenders work with, say, some of these other lenders that you were talking about, the builders, they start that rate. Remember how we were talking about where the rate starts? They take that rate and they jack it way up. And there's several percent that are built into it. And then when they get those incentives, oh, we can just buy your rate down and it comes down. It's kind of like, remember Bed Bath and Beyond? They would send out the coupons all the time, you know, and it's always 30%, 25, and you get them every day in your mailbox. Yeah, every day. Why don't you just start down here, and save the paper. So it's a shell game. That's what it is.
same with Publix, the BOGOs, they always jack them up too. I love Publix, love it. My family works there. Sorry if they're watching.
Or it's
this.
out of date tomorrow.
Yeah, but they jack it up. It's the same thing. They'll start the rate high because there's so much lender credit that they can mask, but they can bring it down. So again, I'm not trying to steal business from in-house lenders. It's not my game. My game is to get them good interest rates and keep their flex cash in their pocket and not waste it all in points. Because a lot of them advertise like, oh, use it towards closing costs. You're not. You're using it towards the points. That's it. Like end of the day, like, and they could go with me and not get the flex cash and get a lower interest rate, and their cash to close is going to be the same because that lender's blowing it in points, and I'm giving them a good rate. Absolutely, yeah, absolutely, I can. Yep, absolutely. I mean, you got to keep in mind too is, I saw one this morning on my way over here, 5.5%. They're charging them $26,000 in points. I'm at 5.8 right now for a conventional. Like to get down to that rate, it would only cost me $4,000. Like that's a $22,000 swing. That's insane. So I'm like, and I told the clients that you take your pick. I'm 4,000 to get you there right now until the rates drop, or you can waste $26,000. I mean, that's kind of where you're at with it. So, Doug kind of pointed to this pretty briefly. Do not listen to the president. Do not listen to the Fed. Do not listen to CNN, Fox News, whoever you listen to. Please don't. They don't know anything about interest rates. What controls the interest rates is investors that are tied to the 10-year treasury. They have a lot of algorithms. So it's all computer generated now, AI. And they got it set up where like, oh, hey, if Jerome Powell, the Fed president says, we're not going to do, rate cuts till September, sell, and the rates drop. If you follow me on Facebook since Friday till today, the rates have came down a little bit. This was early this morning. Yesterday was like from Friday till Tuesday morning was the highest spike in the treasury in history, the highest ever. In that turnaround, we were looking at 3.79 for the treasury. It spiked to the 4.51. That's a massive turn. That caused rates to go up almost 1%, like that quick. It is coming down some. So I tell my clients the same thing. Watch the 10-year treasury. That's what causes it. As you see now, you see where it says 4.30 minus 0.09. That the rates are going to come down. If it sticks to that, I haven't looked at it yet. That would say the rates are going to go down 1/8 of a point, just like that. A lot of times, I hate to say it, when we have bad news and jobs reports, the treasury goes down. When you have good news and jobs reports, the treasury goes up, just how investors react to stuff. So definitely don't follow the news. It's a scare tactic. Follow the 10-year treasury. All my realtors know the same thing. I post about it all the time on Facebook. Super important. And I tell my clients like, hey, I'm locking you at 5 point. I just told one yesterday, I'm locking you at 5.5 on a VA. The treasury's 4.45. Now, if that treasury goes down, we'll move you to another lender, and we can do it as a broker. Right now, I imagine he's probably at 5.39 if this sticks. I haven't looked at it at 10:30 yet, but that gives you an idea.
4.341.
4.341. So it went up a little bit. So he's probably at 5.43 for a rate. So he's down 0.07, which is pretty good overnight. So and I'll tell you, so the difference for me in retail, once retail locks you, you can't move. You're stuck there. Whereas me, say hypothetically, I got a client with Angie and say I lock her at 5.5, and then we wake up and the rates drop. I'm like, hey, Miss Client, I'm going to move you over to Freedom Mortgage and lock you in at 5.375. We do that. It's a lot of work. We have to transfer appraisals and stuff, but I do that to guarantee they're going to get the best rate. And I'll tell you, I tell all my clients when they call me, please call other lenders and rate shop. 3 weeks before closing, I tell them, please call another lender and rate shop because I want to make sure you got the best deal possible because this is the biggest financial decision someone's going to make. And I push it. My team thinks I'm crazy. I'm like, I've never lost a deal over rates, but I want them to know they got the best deal possible. It's just a confidence thing. And it makes them feel better at the closing table, honestly, that they got a good deal. This is the most important thing. Let me get this off the screen. I'm not sure if you guys can see that, but that red link, that's super important. If you don't have that, write that down, save it in your phone, screenshot it. When I get a loan, an application, that's the first thing a client do is opt out. And what that does is if they don't opt out and I pull their credit or any lender pulls their credit, the 3 bureaus sell their information to 5 million lenders and their phone's going to blow up. So what I tell my clients, like when you meet a buyer, the first thing you should tell them is, I mean, obviously you want to say, hey, what's your name and all that stuff and all that good stuff. Are you pre-approved? But you want to give them that link and have them do the 5-year opt-out immediately. And the reason why I say that, it takes 72 hours to kick in. And then you tell them like after 72 hours, go call lenders because a lot of lenders, they got to pull your credit pre-approved. Which is fine, but when those bureaus sell this information, you got to be super careful because there's a certain one that ends in United. I won't say the first name. That's a bank, and they're tied with a lot of realtors. And what they do is they'll call your client and say, "Hey, Mr. Smith, I see you're working with Kalani. That's awesome. But guess what? If you come use my realtor, I'm gonna give you a 1/4% better in rate." And out the door they go, and they'll break a agreement or anything to save on interest rates. So you got to be super careful. It doesn't just protect their sanity of their phone literally exploding. These people don't let up. I had a client that came from another lender, and she said she got 200 calls a day. She has 75 text messages a day and they do not let up.
The average is about 50 for the first couple of days.
Yeah.
Per person. So their phone will ring around on an average about 50. I was talking to another guy in my position with a company out in Oregon, and he forgot to do it when he refinanced, and he got 91 the first 24 hours. And it's not just lenders. It's realtors, it's alarm companies, it's anybody else tied because they know that person is probably shopping for a loan. I will tell you this, there's another big thing that's been going on that we're trying to get Congress to do something about, but that's kind of a tough thing sometimes to do, is they will actually go out and say, hey, Mr. Customer, I'm working with Jeremy on your loan. I need you to send me X, Y, and Z. Or I'm, because they knew that we were the ones that pulled the credit, and they're trying to pretend they're us to get information out of the customer to steal that deal. There are times where customers will unwittingly be processing a loan thinking they're working with one lender because of one of those calls. So this was put out, all 3 of the credit reporting agencies got together, put together this website because they have to give the opportunity to opt out of that sale. This is very important for us to be partners in, because you see that customer long before we typically do if it's referred over. And like Jeremy said, it takes 3 to 5 days for that to, once they do trigger that, to take effect. So it can't be one of those things, okay, I'm ready to pull credit. I just opted out, pull my credit now. It's not going to work. It's got to be 3 to 5 days down the road. So you're really the front line. If you can get the customer to do this up front, you're doing them a huge favor, doing all of us a huge favor. So sorry to interrupt.
Yeah, and the piggyback, I had a client that he's the broker, and I post about it a lot in social media. The broker that he signed the agreement with won't let him out of it now because he got a call from another lender. Was like, hey, if you use my realtor, I can give you a better rate. So it's a big fiasco. But you guys, that's the least thing you want to do is have your lender pull credit and then it gets in the hands of the wrong bank and they're enticing your client like, hey, break that buyer's agent agreement and come over to use one of my in-house realtors that pay us money, and we're going to give you a 1/4% better rate. And I hate to say it, but buyers love they're very rate conscious now because of the media, and they probably love you guys to death, but they will kick you to the curb to save 1/4% in rate. That's why that opt out's super important. You don't want to be driving someone around all weekend and then Monday morning you find out they went with another realtor because of an incentive because their credit was pulled and you couldn't stop it. So I would definitely make that a habit when you speak to them. Save on your phone, send it to them like, hey, do this immediately. Whether you use my lender, whoever lender, like it's going to save a lot of problems and it'll end up costing in the long run. I'm not saying it'll always happen, but you have a high chance of the wrong lender getting a hold of that and entice them with another realtor. So just definitely be conscious of that. This is my final points. I always tell my clients, like, do not fall in love with the rate, fall in love with the cost of the rate. Any lender in America can offer 4%. It's what it costs for that. So you can't, a lot of people get in that mindset, oh, 4%, oh, 4%. It's not really, it doesn't make sense usually. Like you got to look at what it costs. I have clients like, yeah, I lock you at 5.5. I'm like, but hey, I can move you to 5.625 and give you a $3,000 credit. You're never going to recoup that money. Take the free money. And it takes a lot of time. So I always tell my realtors as well, this is what I talk to my clients about. Don't fall in love with the rate, fall in love with the cost of the rate. I am a preferred lender for a lot of realtors, but I tell my realtors, please give my card out with 2 other clauses. I do not want to be given business. I want to earn business. I'll tell you, if you have a preferred lender, it's not me. They should be competing. Just like you guys have to compete for listings or buyers, they should compete. They should have to tell them what their rate is, and they should be able to give them a basic rate without pulling credit up front. I can tell someone a rate instantly. Like, someone can call me right now. What's your rate? It's right here based on your credit range. So I know we love our preferred lenders and there's some in this room that use me. And I love you guys, but I tell them, please send my card out with 3 others. You don't want to be accused of steering as well. That's a big no-no in our industry. Please do that. Like, please, whatever you do, take my card, give it with 3 others, let me compete, like let other preferred lenders compete.
And if they're a good lender, maybe we'll hire them because they can't. That'd be great. Gee, you couldn't beat Jeremy. Let's go join them. We're all about that.
The one thing, like, so I have a stressful job. It's a lot. I had a TIA in October, after the hurricane. I had my heart shocked. But at the end of the day, and I've told Megan's been at closes with me, and I've told her, I say, that stack of paper, all the stuff we went through, like that's the gift. Like we're getting a family into a home. And I tell my realtors when I do presentations, like, think about that. You are driving them around, not just to get them to a home and make a commission. You are putting them in a home. They're going to make a lot of memories at Christmases, Thanksgivings. Like, you guys are the ones that God put on this planet to get them in that home, along with me and Doug. But you guys are the ones. You guys are the superstars. I'm just your backup. I'm just your backup singer. You guys are, Doug's the drummer. You guys are the lead singers. But definitely, take that into account. Like, what you do is a gift. You might not get appreciated by everybody. I appreciate every last one of you guys. I try to post out every weekend, like, you guys are the MVPs. I see what you guys are doing, open houses. I see the hard work you put in. I see Angie going out at 8 o'clock at night with spotlights on, trying to show a home. I see Lisa doing the same thing, and Kalani, everybody. But you guys are a gift, not just to your family, but to these clients. So I definitely commend you, because I'll tell you, I cannot be a realtor. The stuff you guys go through, no, it's a no for me. It's a lot. Like, Angie, love you. I'm not going to sit there with spotlights at 8 o'clock. But yeah, you're, yeah. Let me move this so I can see the bottom one. Sorry. Yeah. The big thing is, and sometimes I get stressed out when I'm doing a deal because deals are hard. There's nothing easy. There's always something going to come up. We do get some cupcakes. It's awesome. I tell my team, just like I tell my realtors, uh, try to stay positive throughout the whole situation. Definitely never reflect negativity to the client because they're already stressed out as it is. So, I've had some hard stuff with Lisa and I called her like, hey, this is a lot, but we're not going to tell the client. We're just going to make it happen. Always be the reason someone smiles. Positivity is like the new swag in our industry. Clients feed off that. When we come and reflect negativity, it's a domino effect. It's just like an avalanche of negativity and any little thing goes wrong. So I definitely encourage stay positive, even though I know it's hot coming up. I know it's hard what you guys are doing. I know sometimes we got to get more addendums and stuff, but if we stay positive in this whole situation, it's a better experience for everybody. And I can tell you, clients, they feed off positivity. Like that's their Snickers candy bar, honestly. Sorry, I'm not good at this, though. All right,
Oh, that's me.
yeah,
Could you maybe move,
I am.
well, that's got to stay there, but can you move that there so I can see it? How much time, Megan, do we have? 8 minutes. I can do this in 4. Um, I like to tell people we have 3 buckets to our company. Jeremy pretty much lives in this first one, the residential side, conventional, FHA, VA, USDA, non-QM. That's the just missed. They used to call it subprime, but that's kind of a dirty word. That actually, believe it or not, jumbos are non-QM. They don't fit Fannie or Freddie guidelines. They're too big. So it doesn't mean it's a bad loan. It just means that it doesn't fit Fannie and Freddie guidelines. So we have a lot of those as well. We have several HELOC equity line products as well. And we can do them actually as a first mortgage. We can do them as a piggyback. So in other words, if a customer is putting down more than 10, but less than 20%, but they want to avoid the PMI, sometimes, not always, Jeremy will tell you which one it is when he does the math, it might make a lot of sense to do a first and a second piggyback HELOC to get down and avoid that. So we do those. Commercial. We had I was lucky enough, I used to be a commercial banker for a while after I was residential mortgage and then went back into it. I was lucky enough to get some folks, including Brian Kazmarowski, who's at Encore Bank, Axiom Bank, handling SBA lending. So we actually do, believe it or not, SBA. We were just talking about builder development, where we work with smaller builders that maybe don't have big lines at banks to actually help them develop their projects, whether it's just one single home that we call urban infill, they're building a home singularly, or they're building a small subdivision, townhomes, whatever, we'll do it. Not only the roads, we'll do the roads, we'll do the street lights, and then we'll do the vertical, we call it, where we're building the actual structures. And bank just missed. We're not going to be a bank. We don't want to be a bank. And we work with a lot of banks. So, hey, a lot of banks will call and say, hey, I can't do it. Can you do this? We can go lower on the credit score. We can go lower on the cash flow that a bank can a lot of times. We can do a 30-year fix where banks will typically balloon it 5 to 10 years. We can do those things. Rate's going to be a little higher for those loans because they're just missed. But this is actually where I probably do most of my personal business is on the investor side of the ball. I speak at national conventions like IMN, 5-Star, whatnot, about this particular product. Like the DSCR, we were doing DSCR products before the DSCR existed, and that's really just for rentals. We do a ton of fix and flips, ground up investor, we just talked about it, neighborhood development. Jeremy can do all of these products. He may not be an expert in some of them, just like I'm not an expert in VA. I'll go to Jeremy for a VA. That's what he loves that. But as a team, we're going to be able to bring a lot to bear for you and your clients. And that's by design. We want to make sure we're able to offer as much as we possibly could to you and your clients. And if you're interested, we would love to talk to you more about these other spaces because think about an investor. You get a fix and flip, or you go out and you sell a home to a nice family that Jeremy helps you with all the time. You do that once in, maybe 5 years, who knows? You deal with an investor, they might be coming to you. I've done 40 some odd loans for one guy, and he just keeps coming back for more and more and more. Last month, I did $2.2 million for him in financing. So that's a gift that keeps on giving. Guess what? When they flip that house, they got to sell it. Who are they going to call? So I'm going to open it up. We have questions, right?
Yeah, yeah.
Because we have maybe 4 minutes.
Can you just call it out to me? I'm not good at this, mate. You go over here. I can do mortgages, but I can't do all this technology.
Yeah. YouTube is your friend when you're trying to figure out tech. And trust me, I'm always doing that.
Okay, so builders have flex cash used for closing costs, rates, buy downs, or upgrades. Can you compete with closing costs, cash out of pocket, or just rates?
Just right. So again, the piggyback, I think it's the guy that asked me the question before, right, John?
Yes.
John, you're definitely, you must do a lot of new construction. Though again, the way we do it is I'll come in, I'll say, hey, hypothetically, say Lisa has a person new construction. I'll look at it like, hey, this is what I can offer. Here it is. They'll take my loan estimate back and they'll say, hey, Jeremy can offer us 5% with no points. Why are you charging me $58,000 in points? Can I compete with Flex Cash? If I'm not the in-house lender, absolutely not. That's used for their club, their kids club is what I call it.
Well,
How-
can I interrupt on that?
Yeah.
Actually, part of that's almost not true, Jeremy, because we can. You think about it, when you say flex cash, they are giving them 18,000 whatever. We start with a base rate. All lenders start with a base rate called a par rate, if you've ever heard of that. Okay, that's basically what it costs us to do the loan. And then there's a markup on top of it. What the lender will do, or what the builder's lender will do, is way mark that up. So when they turn around and sell it, they're getting a bunch of money back. And it might be $18,000. Okay. So it's a shell game like we were talking about. So can we compete with the cash? Sometimes. So it's always best to run by. And when I say the flex cash, I don't really recommend it because you're taking a rate so high that that payment goes through the roof on a customer. But that's where they're starting because they already have it built in. That makes sense. They're just saying, we're going to raise the rate, make more money in the back end, and then we're going to go ahead and give it to the customer as flex cash up front. So technically, you're right. We can compete on both, but we have to decide which one's best for the customer.
But every builder's different. Some can get the 4.99 and they buy it in blocks, so you don't see the points on there. Those are hard to compete with to get to that rate. But when you're talking like they're showing like 5% and they're charging $28,000, or I just saw a VA I'm competing with. I actually won a deal last night, $48,000 for a rate that I can get them at like 8,000. So absolutely, yeah, I definitely can, because they're wasting all their money on the rate that I can give them at a par rate essentially, because they're so high to start with. So when it comes to that, so you take that flex cash out and you're not wasting on points, then yeah, we're apples to apples. The closing costs are the same. Box B through J are all the same. So when it comes to that, if they're wasting all the money in points, absolutely, I can get them every time.
Does anybody have any other questions on? The question was, what states do you write in? They don't, you're online section.
No, it's great. Okay, so residential, we state of Florida. We are looking at maybe going to a couple of other states. There's a lot of expense that's involved in that, including compliance. And we try to keep our rates as skinny as possible. So right now we're just in Florida. These two buckets, we go nationwide with the exception of the state of New York. And that's by my choice.
Do you work with the Hillsborough County Down Payment Assistance?
We do. I work with the SHIP program. I'll tell you, there's some of them, they have preferred lenders that I'm not a part of. Just depends on if they're city of Tampa or Hillsborough County. SHIP program, I've done quite a bit for Hernando County, Pasco County. Any lender can use those. So there is a whole list of them. If you want, I can definitely give them to you that we can use. SHIP's the big one though. SHIP's the real big one.
Yeah, and don't get stuck on down payment assistance. There might be other ways to move the numbers. Yeah, exactly. Like you've learned today, you move one lever, another lever moves. So there's a lot of other opportunities, and they may come in thinking they want down payment assistance, but it might not be in the best interest to do that. So we can analyze it for you.
The big thing with down payment assistance too is a lot of them come with a second lien. So yeah, they're getting $20,000, but they have to pay that back. There was like the Hometown Heroes, like, yeah, it looked great, but you're paying the money back and the rate was 1% higher. So I educate my clients, like, well, do you really want to do it? I can do it for you, but if you ever want to refi or sell that home, then you're paying that $20,000 back. Or I'll come to Realtor like, hey, I know they want to do this. Just so you know, like if they decide to sell in 2 years, they're going to ask you to work for free because they got to pay back this loan and they can't pay for a Realtor. So there's a slippery slope to it. Can I do them? Absolutely. But I definitely educate the client that nothing in life is free, no matter any way you look at it. Now, I do push a lot of grants. I do have one of my lenders, EPM, the rate's higher. They do cover the 3.5% down, and you can refi in 6 months and you don't have to pay that back. So that's a good program to have. So that's definitely one that not a lot of lenders offer. We do have United Wholesale Mortgage Offices 0% down as well. That's not with the county, essentially with the lender driven.
Any other questions? I will send out the presentation, Jeremy's information, and then, your Facebook ID was requested, so I will pull that and send it out as well. He posts all kinds of stuff, especially his interest rates. I see it every day, so. If you guys need anything, let me know and I'll put you in contact with Jeremy.
And also title people, a lot of closers, and Megan's phenomenal. She helps me. She works the extra mile. I can tell you some title companies, good Lord Almighty. But this lady here, she busts her butt. So if you use her, take care of her, bring her coffee, whatever she wants. She's amazing. And thank you for inviting me. You're incredible. Even though you got a twin at my gym, just so you know.